Good afternoon, friends. In the subject of fundamental of investment, in my previous lecture on derivatives, I was talking about future contract. I was talking about the types of derivatives. There are three different types of derivatives: forward, future, and option. In my immediate previous lecture, I was talking about the futures, that what we mean by future, what are the different features of future. So, just to elaborate that, there are different terms that are used in the future contract. While talking of the features of the future contract, most of these terms I have already talked about. Now let me talk in just explanation form the terms that is being used in the future contract. So each future contract, there is a particular contract size and contract value. When I talk of the contract size, what it means, if I talk about the stock exchanges, if I talk of the stock futures, that is the share future. So in a stock future of each of the share, there is a lot size. Like for example, if I talk of a company called Tata Consultancy Service, which is the largest service provider in the field of the technology, in the largest company in the field, which is called TCS. So there is a size. Each contract is of 150 shares, right? So the lot size is of 150 shares. If you want to make a contract in the future market of the TCS share, of the TCS stock, you will have to buy or sell at least 150 shares, right? You cannot buy one or two share of TCS in the future market. You will have to buy or sell, as the case may be, of 150 shares. Means the contract size is fixed. And the contract value depends on the price at which you are buying or selling in the future market multiplied by the contract's price. So if the price in the future market is of TCS is, say for example, 3,000 rupees, and the lot size is of 150 share, I will say the contract value is 4,50,000. That is the price, that is 3,000 rupees multiplied by the lot size, which is 150 share. So the contract value becomes to be 4,50,000. So each contract of Tata Consultancy Service share stock will be of 4,50,000 rupees. So means the contract size and contract value. This is known as contract size and the contract value. Contract size is being determined by the stock exchanges. Contract cycle. See, when you make future contract, it is for a predetermined period. And this contract period may be for 1 month, 2 months, 3 months. In India, at the most 3 months future contracts are allowed. So contract cycle is a period over which a contract trades. So the maximum number of index future contract is of 3 months contract size, right? So 1 month, near month we call it, 2 months we call it next month, 3 months we call it far month, right? So these are normal terms that is being used in the exchanges. So there is a contract cycle. The bottom line is we call it contract cycle. It may be a month, 2 months, 3 months, but in India, in future market, especially in the stocks, the 1 month contract is very popular. Future price. It is the price at which the contract is being undertaken. So it is the price which is to be paid or received while trading in the future market. This price may be different than that of the current price, right? Why the price difference takes place, I will talk today itself in my lecture. But at this point I will say that there is a particular price at which the future contract takes place. It may be more than or less than the current price. If I continue with the example of TCS, if the current price is 3,000 rupees, the future price may be more than 3,000 rupees, or it may be less than 3,000 rupees, right? So the price of a future contract is determined by spot price of an underlying asset. As I am saying, I'm underlying asset in my example is Tata Consulting Service, share of stock of Tata Consulting Service. So what is the current price? Current price is say 3,000 rupees. So what is that is called spot price. Price that is prevalent in the stock exchange at a point of time. That is called the spot price. Adjusted for time and dividend approved, right? Since you are making a contract after a month, and TCS might have declared dividend. So TCS has declared a dividend of ₹8 on each share. And if this is the month of the July, and the July that the date that is being fixed for the declaration of dividend is 24th or 25th. Today is presuming it is 13th, right? So on 13th of July, if you are making a contract and on which a dividend will be given, those people who will be holding the share on 24th, so the 8 rupees dividend will be given. So while determining the future price, and your contract is of the end of the July, last Thursday of July, which comes to be, say, for example, 28th of July. So on 28th July, the settlement will take place. So while keeping in mind, while fixing the price, you have in your mind how much dividend is involved in the purchase and sale of share, means who will be getting the dividend. Adjusted for time, if it's a, like say, if supposing today's 13th, the expiry date is 18th, so only 15 days are involved. If you are making contract in the beginning of the month, the 1 month is involved. So because basically, theoretically speaking, the future prices is determined on the basis of cost of carry, right? But practically in the market, it is the demand and supply forces that determine the future price of an underlying asset. If the demand of the underlying asset is high, is increasing day by day, so the future price will be high. If the demand is less, it means there are more number of sellers as compared to the buyers. In the future market, the price will be less, right? So means, but theoretically speaking, adjusted for time and dividend approved, expiry of the contract. Expiry, as I said, normally in India, in future contract, especially in the stock exchanges, last Thursday of every month means each month is the expiry day or expiry date of the future contract. So how many days are left in the expiry of the contract? If it is a 3-month period involved, so 3 months future contract you are making, so means 3 months are involved, right? If you make in the beginning of the first day of the first of a particular month, say July, and the expiry of the contract is September, right? So 3 months are involved. So more time is involved. The longer is the time period, larger will be the fluctuation in the future price and the current price, right? Spot price, I have already spoken that what is the current price, that is also important while determining the future price. Cost of carry. See, theoretically we always say that future price determines on the basis of cost of carry model. What is the cost of carrying the contract for a period? Depending on the risk-free rate of interest in the market. If the risk-free rate of interest is high, the cost of carry will go up. The longer is the period, the cost of carry will be high. The shorter is the period, cost of carry will be low. And if the rate free means interest-free rate is low, certainly cost of carry will be low, right? So it is the cost to be borne by the trader for wait time till the future contract expires. See, if the future contract is of 3 months, it means both the buyer and the seller will have to wait for 3 months, right? So it depends on the period, it depends on the risk-free rate of interest, it depends on the time period is 3 months, the rate of interest is this much. And so these are the important factors on the basis of which cost of carry will determine. Expiry date, I have already spoken about it, right? So initial margin amount. When I was talking of the features of the future contract in my previous lecture, I was saying that whenever a contract is being undertaken in the future market, there is an initial margin amount that is being kept by the exchanges, right? So this initial margin amount determine of the contract value, right? If the TCS, the price of the contract is 4,50,000 rupees, 3,000 rupees is the price at which the contract has taken place of the TCS share, and this lot size is 150, so 4,50,000 rupees is the contract value. And if the margin percentage is 10%, right? So the margin will be the 45,000 rupees. Say for example, if I take another example, the Reliance Industries. The Reliance Industries, say the price of Reliance Industries is, for example, 2,000 rupees or 2,200, let me take 2,000, a simple figure, 2,000 rupees. And the lot size of Reliance in the future market means each trade is of minimally 250 shares. Each lot is of 250 shares on the exchanges, right? So 2,00,000 multiplied by 250 shares. That will be 5 lakh is the contract value. And if the margin percentage is 10%, it means at the time of making the contract by the buyers and the sellers, the initial margin that will have to be kept is the 10% of the contract value, that is 4,50,000 rupees. 2,000 multiplied by 250 rupees, that comes to be 5 lakh, right? So 5 lakh, 10% of 5 lakh comes to be 50,000 rupees. So initial margin will be 50,000 rupees. Apart from this initial margin, there is a mark to market. That is also a margin that has to be kept. In future contract, gains or losses are settled on continuous basis at the end of each trading day. Not only on the expiry day, but the difference in the price is being settled on a day-to-day basis, right? So this is known as mark-to-market settlement. The contract will be set off only at the end of the expiry period, but the margin has to be kept on a day-to-day basis. So we say almost the contract means there is no default risk, so that the default risk doesn't take place. Mark-to-market margin is being kept by the exchanges. So, right. So it is a simple accounting procedure which involves adjusting the profit or loss made for each day, for the day. It reduces the counterparty risk for the investor in the future contract, because it is the exchanges which guarantees the fulfillment of the contract. So because if there is a large variation in the price, one of the party may deny, may say, or may not fulfill the contract. In order to avoid that risk, what exchanges does and what exchanges do, that they ensure that both the parties keep the margin of the fluctuation that takes place between the contract price and the current price at the end of the day, right? So it ensures that there will not be any outstanding obligation which indirectly reduces credit risk, right? So as long as trader holds the future contract, mark to market is applicable. When I am saying mark to market is applicable, it means the margin has to be deposited with the exchanges depending on mark to market difference in the price. Like I have taken a small example. Price of Reliance in the future market is 2,400, right? Lot size of the Reliance future is 250 share. Contract value is, it means 2,400 multiplied by 250 share, because I am saying each lot is of Reliance contract is of minimally 250 shares, right? If you want to make the contract of 500 share, you will have to buy 2 lots, right? So it cannot be 400 shares. It is, since the lot is being decided by the exchanges, so lot is of 250, so you can purchase or sell in the lot of 250 shares, 500 shares, 750 shares, 1000, means in the difference of 250 shares, and that many lots you can buy or sell. So lot size is 250 shares. So the contract value is 2,400 multiplied by 250, that comes to be 6 lakh. So initial margin is 10% of the contract value, if I am presuming, because again I am saying that the margin depends on the level of fluctuation in the share. The margin is being determined by the exchanges and it keeps on changing, because when I am saying keeps on changing means for the new contract, the exchanges will determine in advance that this is the margin, this is the minimal margin, initial margin for a particular share. So if on Reliance the initial margin is 10%, that is being fixed by the exchange, so the initial margin will be 60,000, 10% of 6 lakh rupees. And now what is this mark to market works? Current trading price is 2,400. Suppose the closing price comes to be 2,450 rupees. So the difference in the price is 50 rupees, right? So number of shares is 250. So total difference is 50 into 250. So mark to market means 12,500 rupees is the mark to market margin, right? So the trader has to deposit the mark to market margin for this, right? Has to deposit this difference, has to deposit the initial margin, plus the initial margin is 60,000, right? Not 40,000 rupees, it is 12,500, and the initial margin has already been deposited, right? So now, after talking of the features of the future market or the futures, there are 2 types of futures. If I am talking of the stock futures or the index futures, means we are talking of financial futures, especially in context of the stock market. So in the stock market, there are 2 types of futures that are prevalent. One is called index future, the other is called stock futures. Index futures means the futures of the whole index. When I say index, if I am talking again of the stock market, 2 important exchanges like say BSE. So the BSE, the index of the BSE is called Sensex. So instead of one share where the risk is high, Sensex consists of 30 shares. You feel that the market will go up, right? So you want to buy the index in the future market. So what you do, instead of buying one stock, what you can do is you can buy index in the future. What it means is that in the stock exchanges, or I would say in the financial derivatives, especially in context of the futures, right? So the purchase and sale can be made of the whole index also, right? If I talk of the NSE, NSE consists of 50 shares. So the index of the NSE is called Nifty. So you can buy Nifty in the future market, or in the BSE market, Bombay Stock Exchange, you can buy basically the Sensex in the future market. So in index future, the underlying asset is a stock index or indices. Means not a particular stock, but rather stock index or indices. Right? Whether you call it index or indices, same thing. Investors make money on the performance of the index. If the index goes up, and if you're a buyer, you will get the benefit, you will be making the money. If you are a seller and the index goes up, right, you will be losing the money. So it is an agreement to buy or sell a standardized value of a stock index on a future date at a specified job. As we have already talked about this, that is of a standardized value, right, at a future date and a specified price. So you can buy and sell the way you buy and sell the stocks in the future. Similarly, you can buy and sell the index in the future market. So a stock index is constructed by selecting stocks of similar companies in terms of industry or size. See, this index can be of the stock exchanges, like I've talked about in the BSE, the Sensex, or in the case of NSE, the Nifty, or it may be of a particular sector. Like in case if you're bullish about the banks in India, you feel that the economy is growing, the banks will perform better in the time to come, and the banking sector will do better. You can buy the whole Nifty. You can buy the banking Sensex. Banking Sensex means you can buy the banking sector. There is an index of the banking sector also, which is there prevalent in both NSE as well as BSE, right? So you can buy the index of a particular sector also. Instead of a particular whole market, you can buy. If you are bullish on IT companies, you can buy the IT companies sector index, right? So stock index is constructed by selecting stocks of a similar companies in terms of industry or size, right? Say for example, if I take the example of a banking index, right? So this banking index consists of all the large banks in the private sector as well as in the public sector banks of India, and a basket of stocks like all good companies. If I name a few names in the banking sector, like the large public sector banks in form of State Bank of India, Bank of Baroda, Canara Bank, a few others, right? And in case of private sector bank, HDFC Bank, ICICI Bank, Kotak Bank, Axis Bank, these are the four largest banks in the private sector, and the PSU have named 3 banks. So say for example, these 7 constitutes an index, right? And somebody is bullish on the banking sector, what the person will do, that it will buy the banking index, right? So index may be of a whole market or it may be of a particular sector. Now I have taken an example here. Suppose the BSE 30 section stands as 54,000 points in the cash market. An investor decide to purchase on one BSE 30th July future, means I am saying 30th July future means I am presuming that in July month the expiry is on 30th of July future at a price prevailing in the future market, right? This price is determined on the basis of value, means the value is the price of July future contract could be anywhere above or below at rupees 16,20,000 rupees. How this figure has come means I am presuming each point is of 1 rupee, right? And there are 30 shares involved, 54,000 multiplied by 30. It is just an example to understand, right? Or it may be you may say 50, each index point is of 1 rupee, or right? So I would say 54,000 multiplied by the 1 rupee, and I am taking the lot size is 30, right? I am presuming the lot size is 30. So lot size is of 30, right? So 54,000 multiplied by 30, that comes to be 16 lakh 20,000 rupees. Depending on the prevailing market condition, the profit or loss depends on the difference in the price. Means in the future market, if you are a banking index, the contract value of each index future is 16 lakh 20,000 rupees, right? And depending on the fluctuation in the index, the profit or loss will arise. If the stock future in the underlying asset is an individual stock, meaning the other is, instead of index future, it can be stock futures also. So in a stock future, the underlying asset is an individual stock. I have named many examples. I have taken many examples. I was talking of the TCS. I was talking of the State Bank of India, Reliance Industries. For that matter, there are very large list of companies which are being dealt in the future market, right? So you can buy and sell in the future market any of these shares which are there in the future in the exchanges, right? So in the stock futures, the underlying asset is a individual stock. Every stock future contract consists of fixed lot of underlying shares, right? So for example, if I take the example of State Bank again, SBI stock future have SBI stock as the underlying asset. Now after talking of the stock futures and the index future, friends, very quickly let me tell you the difference between the forward market and the future market, means the forward contract and the future contract. If you recollect in the previous lecture, when I talked about forward contract, I said it is a OTC contract, over the counter contract between the two parties, right? And which is the terms and conditions of the two parties are being determined by the two parties themselves. What will be the size of the contract, when will the expiry date, right? What will be the price, that is all being determined by the mutual agreement of the two parties. But in this very lecture, I said in the future contract are standardized contract. Since they are a standardized contract, so they are being dealt through exchanges. So as far as the forward contract are concerned, it is an agreement entered into by two parties to trade asset in a future date at an agreed rate. There can be any date depending on the agreement between the two parties. The rate is being fixed by the two parties. In the future contract is a contractual agreement between the parties to buy and sell a particular asset in future for a particular price on a particular date, right? So this price and date means there is an expiry date, and future contracts are being dealt through through exchanges. So the date of the expiry will be determined by the exchanges, right? If both the parties agrees to fulfill the contract on that day or before that day, right, it will be in the future contract. Settlement means in the forward contract, upon maturity, whatever the date may be. In the future contract, since there is a mark to market, there is a very large number of buyers and sellers which dealt in the future market on each day. So you can set off your contract any time, even before the date of the expiry also, right? Because when you are making the contract, it is not the contract between the two parties. You are making the contract as a buyer, the other party is the seller. So if you want to set off, if you are a buyer, you want to set off any seller who want to sell that particular underlying asset, through that it can be set off. It is the exchanges through which the transaction takes place, irrespective of who the buyer is, who the seller is, right? Contract terms. In the forward contract, contract terms are mutually agreed upon, the customized contract. If I am selling my wheat in a forward contract, it is the trader. If I am a farmer and I am making a deal with the trader in the forward market, I am fixing the price, the quantity, the contract period, right? And it is the trader who is between the mutual contract of myself, that is the farmer, and the trader. The contract takes place. So it is a customized depending on the buyer and the seller. But here the contracts are being determined by the exchanges. That is, they are standardized contract. What will be the, say, if I talk of the stock futures, right? What will be the size of the SBI contract? Lot, what will be the lot? It is 250 share. So the standardized contract is there. Expiry date is fixed, last day of the Thursday of each month. It may be 1 month, it may be 2 months, it may be 3 months. Suppose in India 3 months future contracts are allowed, so I cannot make a contract for 6 months, right? I may make contract for 3 months, then again I can roll over or I can make fresh contract, but a fresh contract has to be made. At one go I cannot make a contract of 6 months. Nature, as I said, is a forward contract, is over the counter, means between the two parties. In the future contract, they are organized through stock exchanges. If I am talking of the financial future contracts, means stocks or the index, right? So after talking of this difference, I hope you have understood the difference between the forward contract and the future contract. Basic difference is that forward contracts are the over the counter between the two parties depending on the terms and condition of the two parties. As far as the future contract are concerned, since these contracts are made through exchanges, so the contract is standardized, fixed by the exchanges. There are certain margins which are to be fixed. There is a mark-to-market margin, there are initial margin, and the stock exchanges ensures that the contract is being fulfilled. So friends, this is about the forward contract and the future contract. Thank you very much.